You ordered something on Amazon this week. Maybe today. A phone charger, a book, a bag of coffee. It showed up in 2 days, sometimes one. You didn't think twice about it. But here's the strange part. The company that just delivered your package barely made any money doing it. For most of its history, Amazon has run on razor-thin profit, sometimes losing money outright, while becoming one of the most valuable companies on earth. That shouldn't work. In nature, in business, in your own gut instinct, spending more than you earn is supposed to be a death sentence. So why did investors keep handing Jeff Bezos billions of dollars while he lost money on purpose, year after year? The real answer isn't about greed or bad math. It's about a strategy older than capitalism itself, one that shows up in your own brain every single day. Think about the last time you skipped a small reward to get a bigger one later. Maybe you didn't buy coffee out so you could save for a trip. Maybe you stayed in on a Friday to study for something bigger down the line. Your brain did that calculation instantly. It weighed a small payoff now against a larger payoff later, and it chose to wait. Psychologist Walter Mischel spent decades studying exactly this trade-off. In his famous experiments, he sat children in front of a single marshmallow and told them if they waited 15 minutes without eating it, they'd get 2. Some children grabbed it immediately. Others stared at the wall, sang songs, covered their eyes, anything to resist. The ones who waited weren't smarter. They were running a different internal program, one built to sacrifice the present for a bigger future. Amazon runs on that exact program, just scaled up to the size of a global corporation. Here's the reframe. Amazon was never trying to make money selling you a phone charger. It was trying to become so large, so fast, so essential to your daily life, that competitors couldn't survive in the same market. Making a profit on that one sale would have meant charging you more. Charging you more would have meant fewer people shopping there. Fewer people shopping there would have meant slower growth. So Bezos made a choice most executives are too afraid to make. He told shareholders, openly, in writing, that he wasn't optimizing for quarterly profit at all. In his 1997 letter to shareholders, just 3 years after founding the company, Bezos wrote that it's all about the long term, and that Amazon would continue to make decisions in light of long-term market leadership rather than short-term profitability. That single sentence became the company's entire operating philosophy for the next 2 decades. Every dollar that could have gone into a shareholder's pocket instead went into faster warehouses, cheaper prices, bigger selection. Amazon deliberately kept its prices low enough, and its investment high enough, that profit margins hovered near zero, sometimes negative, for years at a stretch. Wall Street analysts called it reckless. Wasn't a company supposed to make money? But here's where it gets stranger. This isn't a new idea. It's a very old one, and economists had already given it a name. In 1958, economist John Magee published research examining Standard Oil, the 19th-century company that dominated American oil refining. Standard Oil had been accused of predatory pricing, slashing prices so low in a region that local competitors went bankrupt, only to raise prices back up once the competition disappeared. Magee's research complicated the popular story, but the underlying pattern he studied became a foundational case in economics. A company can absorb short-term losses specifically to eliminate rivals and control a market for the long run. Amazon didn't need to bankrupt anyone directly. It simply made competing so unattractive, so financially punishing, that most companies chose not to try. Picture a small bookstore in the early 2000s watching Amazon undercut its prices on every bestseller. The bookstore has to make a profit to survive. Amazon doesn't. That's not a fair fight. It was never supposed to be. Amazon could subsidize low prices using investor money that believed in the long game, money that had essentially agreed to wait 15 minutes for 2 marshmallows instead of grabbing one now. Investors weren't funding a bookstore. They were funding a strategy of patience, at a scale no small business could ever match. Look closer at the actual numbers and the strategy becomes even clearer. For most of the 2000s and well into the 2010s, Amazon's profit margins hovered near 1 or 2%, sometimes dipping negative in a given quarter, even as its revenue climbed into the tens of billions. A traditional retailer watching those numbers would have panicked. Amazon's leadership treated it as proof the plan was working. Every extra dollar of revenue that didn't turn into profit had gone somewhere specific. Cheaper 2 days shipping, more warehouses closer to major cities, deeper price cuts on the products people bought most often. None of that showed up as profit. All of it showed up as market share. And market share, unlike a single quarter's earnings, compounds. This is where the strategy starts to look less like recklessness and more like patience weaponized. A restaurant that undercuts its competitors' prices for 1 month is taking a risk. A company that can undercut competitors for 15 years, because its investors are willing to wait that long, isn't really competing anymore. It's simply outlasting everyone else at a pace nobody else can afford to match. Now here's the counterintuitive twist. Losing money wasn't a side effect of Amazon's growth. It was the engine of it. Every dollar Amazon didn't take as profit became a lower price, a faster delivery option, a new warehouse closer to your city. Each of those improvements brought in more customers. More customers meant more data about what people wanted to buy. More data meant better recommendations, smarter inventory, less waste. This is what Bezos and his executives eventually called the flywheel, a self-reinforcing loop where growth fuels efficiency, efficiency fuels lower prices, and lower prices fuel more growth. A flywheel is heavy and slow to start pushing. But once it's spinning, it barely takes any effort to keep it moving. Amazon spent almost 20 years pushing that wheel, absorbing the cost of every push, waiting for the moment it would start spinning on its own. Think about how strange that timeline actually is. 20 years is longer than most companies survive at all. It's long enough for a child born the year Amazon started selling books online to graduate college before the company reported serious, consistent profit. That's not a business plan most people would sign up for. It requires believing in a future you can't yet see evidence for, based purely on the shape of the trend line. Few founders have the stomach for that kind of delay. Fewer investors do either. Amazon's success wasn't just a clever business model. It was a bet that patience itself was undervalued by almost everyone else in the market. You can see this same pattern in your own life, just at a smaller scale. Think about someone building a skill, a business, a body of work, who spends years earning very little while they build an audience, a reputation, a network of trust. From the outside, it looks like failure. Why work so hard for so little return? But if you understand the marshmallow experiment, you understand exactly what's happening. They aren't measuring success by this month's paycheck. They're measuring it by the size of what compounds later. Behavioral economist Richard Thaler spent much of his career studying why most people are terrible at this kind of patience, why we're wired to grab the marshmallow now even when we know two are coming later. Waiting requires fighting a very old, very powerful instinct. That instinct exists for a reason. For most of human history, waiting was dangerous. If food was in front of you, eating it now meant certainty. Waiting meant risking that someone else would take it, that it would spoil, that you'd simply go hungry in the meantime. Your ancestors who grabbed the guaranteed meal in front of them often survived longer than the ones who gambled on a bigger reward that never came. That instinct got passed down to you. It's why saving money feels harder than spending it, why waiting for a bigger opportunity feels riskier than taking the smaller one right now. Most companies operate the same way. They report to shareholders every 3 months, and every 3 months, that ancient instinct kicks in. Grab the guaranteed profit. Don't gamble on some payoff 5 years away. Amazon's advantage wasn't a better product. It was rewiring that instinct at the corporate level. Bezos built a company culture and a shareholder base, willing to override millions of years of survival programming and hold out for the second marshmallow, except the second marshmallow was a trillion-dollar company. Harvard Business School has long studied this kind of strategy under the label of cost leadership, the idea that becoming the cheapest, most efficient option in a market can be more powerful than being the most profitable one, because efficiency compounds while profit margins can be copied overnight. Amazon didn't just want to sell things cheaply. It wanted to become the infrastructure other companies had no choice but to build on top of, from cloud computing to shipping networks to marketplace tools other sellers now depend on completely. Consider what happened to the industries that didn't understand this in time. Toy retailers assumed Amazon was just another discount catalog. Electronics chains assumed customers would always want to touch a product before buying it. Grocery stores assumed perishable food could never be shipped efficiently. One by one, each assumption turned out to be a bet against patience itself, and patience, funded at Amazon's scale, kept winning. The companies that survived weren't always the ones with the best products. They were the ones who realized, often too late, that they were no longer competing on price or quality. They were competing on how long they could afford to lose money while waiting for a bigger future. So the next time a package shows up at your door 2 days after you clicked buy, remember what you're actually looking at. You're not looking at a company that got lucky, or a founder who got rich by accident. You're looking at the largest, most disciplined marshmallow experiment ever run, played out over decades instead of 15 minutes, funded by investors patient enough to believe the second marshmallow was real. Your own brain runs a smaller version of that exact same program every time you choose to wait for something better instead of taking what's in front of you right now. The only difference between you and Amazon is scale, and how long you're both willing to wait before anyone gets to eat.